Good evening, ladies, gentlemen. We're live Friday night, baby. I got a heck of a conversation that I didn't plan on doing because I decided as a 30-year-old to go out with some friends last night and not even having a beverage or two, like literally no alcohol. I woke up pretty much hungover today. I took a nap this afternoon. I'm like, frig, 30s blows. I'm like, you go out for a nice all you can eat dinner, get some coffee after there at some Dimitri's, and you just chilling out till 12:31 a.m. It hits just different, baby. But probably run the stream a bit quicker because I've already got my shorts on here. I'm waiting to go down to the sauna. You can't even see my shorts that I'm wearing, but I'm looking to relax this Friday. But I got to get into these conversations because I am always so giddy to talk about stocks. And man, oh man, there's been a lot of conversation going on. So we're going to talk about Google, how I'm investing $10,000, probably preemptively to what I originally had planned by pulling it out of my corporation and putting it into my tax-free savings account that I really need to start topping up. And I'm going to explain why I'm kind of going about this decision making. As I even started doing some investing today, I took about another couple $1,000, threw it in the S&P 500. Of course, I'm talking about Canadian dollars. I wish it was US because I bought like 3 shares of VOO, which still equated to a wicked amount of Canadian dollars, baby. And we're going to do some updates on Aduro at some point as well. I could probably do some updates today. But nonetheless, I really want to get into this conversation. It's been stirring the pot as of late, and that has to do with Google, right? Now, I've been talking about getting back into tech stocks, and I'm going to come down on Google here pretty hard on why I think Google is probably one of the most valued setup stocks. Then we're going to talk about SCHD, some of the dividend payers, because we're getting like record dividend yields as well. It's going to be a well-rounded conversation for just about everybody today. But I talked about Google today specifically, especially the Gemini project, which isn't really an aspect of the Bard system they're currently using for their AI. In comparison to ChatGPT. But somebody made a good point here, and they kind of calling me out a little bit. And they're saying this didn't age well. Alphabet lags behind the other big tech players for a reason. It's nice to see you talk about more U.S. stocks. The fanfare for no growth Canadian dividend stocks is stagnating your followers' finances. And some guy, Elephant Money's like, he just posted this today. And this guy replied saying, after they were outed for faking their AGI demo, which was their Gemini project, he's boasting bank stocks and worst of the tech stocks. Whoever takes his advice will hamper their returns. First and foremost, don't take my advice. I'm a clown on the internet. I only just show you what I'm doing and kind of rant about a lot of stuff. And I just buy stocks at the end of the day. That's my only core message here. But I really want to break this down because so many of you have been calling me out on this because I definitely didn't get the updated news. And I want to talk about this AI, specifically Gemini, and I'll probably just address the aspect of it first that was the demo fake. And it wasn't that it was faked. It's that it was kind of sped up. It was it is an actual tool that they've created that works. It's just a matter of they really kind of, they did a little bit of movie magic editing to make it look a little bit more streamlined than it is, which we've kind of even seen you've seen Tesla do it with their AI robot, yet nobody made a big fuss, as much of a fuss about it. But I get it, right? And I'm not really as fixated on Gemini as I am Bard, because Bard, as far as I can tell, is the more advanced system over ChatGPT for those using it, which we're going to break down. But I want to explain to you why Google should be kind of more in comparison with the likes of Apple's market cap today. And I know I'm doing a little bit of stretching here, but I think it would be fun as a little thought experiment, a little bit of math, balance sheet understanding to teach you guys some stuff and get a better understanding of, I used to say Meta was the best stock. Like, it was the most value, cheapest, best thing you could buy. And these are like Meta's numbers here, based on their growth. And I used to say that because Meta used to be the kid on the block that was always beaten down. It always got the most hate. Mark Zuckerberg was like the kid on the playground that was made fun of, and the stock always changed, traded at really cheap discounted values. It's the largest single stock position in mine and my fiance's portfolio still. We're not buying any more of it, by all means. But now the new kid on the block that I think is the most favorably valued is obviously Google. And I want to explain to you why by comparing it to Apple's income. Now, Meta's got a long way to grow. It's likely Meta still has a better chance at growing at a bigger pace than Google, because Google's at a much larger scale than the likes of Meta. But I really think Google should be trading at a much higher multiple. I'm going to explain to you why. Firstly, you can kind of see from a growth standpoint, even during this recessionary environment, Google only had like one quarter where they saw like negative year-over-year quarterly growth, whereas Meta kind of got hit pretty hard in that kind of, interest raising environment of 2022, where people were scared to spend ads and they were clearly more focused on Google than Meta. So Meta got hit a little harder. I think Google is just a little bit more steady. Like the revenue growth and everything about it has been a little more streamlined during a rockier market environment. But what really matters to me is the earnings, right? And I just want to show you some of these crazy comparables because with Meta here, their revenue growth was astounding. Their net income grew dramatically because they started cost cutting. They managed to increase their operating margins by 40%. Like you look at Meta, and this is what this kind of smaller growth company should be exactly like. But when we get to the scale of Google in comparison to Apple, and I know if we're talking about margin, there's no better company than NVIDIA, but I just want to show you, because if you just look at Meta versus Google, you'd say Meta's the better growth company, right? But you got to imagine that Meta or Google here is making $76 billion in revenue for the last quarter versus Meta that only made $34 billion. So there's a big difference in the amount of revenue these two companies are generating, which is why I want to compare it more to Apple, because basically their operating margins were only 28%, again, nowhere near Meta's at 40%. But what I want you to notice is that their net income was $19 billion, okay? $19 billion. Keep that figure in mind, because it's going to be very important in a moment here. And I also want to scroll down, and I want you to take a look at the assets minus the liabilities. So if you go on Google's balance sheet here and we just scroll all the way down, we can see that Google's sitting on $365 billion of assets and only $109 billion in liabilities. So they're basically sitting on $260 billion of assets after their liabilities, right? If we compare that to the likes of Apple, Apple's net income was almost $23 billion. Now, I find it interesting because they make quite a little bit more net sales, but the net income isn't that far of a cry from the 19 billion or the almost 20 billion that Meta's bringing, or Google's bringing in, right? So there's some very close comparables to the actual net income these two giants are producing. And the other thing that's most intriguing about Apple is they're sitting on $352 billion of assets, but a liability of $145 billion. So Google actually has a better asset ratios than Apple does, which is kind of mind-boggling to consider, right? Because Google's got more assets and they've got lower liabilities, whereas Apple has less assets and higher liabilities. And I don't think people are fully taking this into consideration when we talk about value, but I'm going to talk why I think Meta's trading at the way it's trading, because you got to imagine Apple's trading at a 32 times multiple and over $3 trillion market cap, whereas Google's trading at a $1.7 trillion, almost half as much, and a 25 price to earnings, or 26 price to earnings, give or take, right? But the difference between these business models, and I think some of the risk and maybe that's priced into Google, is that Apple is a much more secure business, in my opinion. It's not as heavy in margin, in my opinion, as marketing can be. But the thing with Apple is they control the ecosystem that Google operates on. In fact, you might know, if you've done enough research, that Microsoft offered Apple pretty much billions of dollars in most of the revenue from their search platform if they would drop Google and use their platform. I think it was Bing or whatever the hell they wanted them to use at the time as their primary search platform. And that obviously didn't happen. So at any point in time, Apple could completely terminate the agreement to have Google as the primary search, tool that comes up on the, as the standard iPhone that just comes with it on browsing on Safari or whatever, right? So that's like one of the nails in the coffin that keep Google, I think, at the level it is now. Maybe their branding's powerful enough now that if Apple did that, people would just go download the Google app. I don't really know if the branding powers is that strong today. It might be, but still, nonetheless, you cannot help but recognize that Google trades for the lowest price to earnings multiple of the S&P top 10. It has one of the most resilient balance sheets. It's rode through this terrible recessionary environment with ease. And of all the stocks you could buy today, this is probably the one that you should be buying. And I want to talk about it from another metric with this AI stuff, because I think AI is a bubble. I think when you're talking about stocks like Palantir and NVIDIA, you have to be hyper careful if you are investing and not trading those kind of companies, because inevitably the steam is going to burn out to some extent with these kind of companies, right? Like you can't keep up 100% growth rate on a company like NVIDIA, like I mentioned, without AMD or other companies coming for your lunch. You can't be making 70% margins and growing at that rate without somebody else being like, we can do that. Like, it's an inevitability that they're going to hit a brick wall, and you're going to start seeing some price compression as competition comes into play. That's the way capitalism works. So it's just a matter of how long can they sustain it for, right? So then you got the AI programs, that's funding all of this. This is like, these AI programs are the reason that NVIDIA is exploding, right? So when you look at something like Bard, and what makes it so intriguing over ChatGPT is, as far as I can tell, it is a better system. I mean, there's a good video Google did with Mark Rober. I'll skim through it, just give you an idea.
Defining accuracy.
Bard and I talked about accurate.
They basically use Bard to make the best paper airplane possible.
Target practice, hoop shots, obstacle courses, and the dartboard challenge.
It was the glider versus the Concorde versus the Canard. Which of these will be the most accurate and why?
The Concorde paper airplane is likely to be the most accurate.
I hit the camera, man. I'm so
It's a
sorry.
very fun video just using the AI to basically build this whole project to a level that no student's ever going to have the capability to do on their own, right? So it's a very good educational tool. But what I really appreciate most about Google's Bard is the smaller YouTube community. And at the end of the day, I will always kind of appreciate the smaller YouTubers, because in the early days of YouTube, before you get corrupted by obviously capitalism and making money on sponsors like I do, I'm a victim to this, of course. Like I have pretty some opinions of mine, though they are opinions of my own. They are paid sponsorships, whereas these smaller YouTubers, they have the luxury of not giving a shit. They just say whatever they want, and a lot of them have come to the conclusion that Bard is a much better system depending on what you're trying to do, right? Because Bard over ChatGPT, Bard is more for like information today. It's good for solving specific problems, whereas GPT is good for basically writing like articles and doing more online. It's not as it's more dated information. You're not getting up-to-date stuff like you are with Bard. So I just find it so intriguing, right? That people are just shitting on Google, and Google stock is tanking on that news that they've so-called faked their demonstration, right? So obviously I want to take advantage of this, and I am going to be buying some Google shares. I really want to buy some Google shares, but I had a goal in mind first and foremost, and that was getting to about 100,000 USD invested in the S&P 500, primarily starting within the corporate account. In my TFSA next year, I'll be buying a lot of the S&P along with some of these Canadian dividend payers, but I pretty much got there. I wish it was in USD, but I'm sitting on about 73, 74, or 72,300 as of this moment. I purchased about 3 more shares this morning. It hasn't updated my my average cost on it. It usually takes a day or two for Royal Bank to adjust it. So within my corporate account, the big problem that I'm having right now is that I have a nice sizable amount of cash, and I was debating on just pulling it out at the beginning of next year so I can avoid paying tax on it for the whole year, and then dumping the majority of it minus the 30% I pay in tax into the TFSA to top it up. But the problem with that is I'm starting to realize that how much money am I losing doing it? And it's starting to become inefficient because I'm getting into the higher tax bracket range of thing, which we'll discuss in a minute here. But I'm just looking at basically starting to round out the portfolio. And as mentioned, I'd rather buy the Qs, but because me and my fiance, she holds a lot of the tech companies, I just want to upperweight the tech companies that she's not as heavily exposed to, like obviously Google, Amazon, because we have a lot of exposure to Apple, Microsoft, and Meta right now, Meta being the top weighting just because of the growth that it has had. So I'm just trying to equal weight our portfolios out going into next year. And I think it's more tax efficient to only pay 15% on the corporate income tax rate than pay 30% and lose an extra 15 just to have the option to, put an extra 10 grand in my TFSA, because I'm saving myself like an extra $1,500, right? So, I mean, that does add up over the long term on the investing side of it. And we'll take a look at that deeper. But first and foremost, the portfolio today, again, is very boring in consideration. I'm going to do a January update when we finally kind of fully round out all of our portfolios. And I'll do maybe I'm not going to do it very often because, again, I don't like talking about everyone's portfolio here. But, me and my fiance are building this as a team here, and we're trying to get to a place of financial independence. So I'm going to do one combined video where I'll probably maybe do further updates to the patron side of things. But I think it'd be good and healthy to show you why I make the decisions I make within this portfolio, because it's a little bit more conservative if you're just looking at this, but it's coming from a place of further diversity from the concentration my fiance has, because she's not willing to sell her stuff. She's one of those people that's ride or die. I'm in and out of the market. She just rides it, forgets it even exists, and it's done much better for her than it would have done for me if I just held those stocks, right? But again, there's stocks that I could have held where if I rode them through, I would have lost a substantially large amount. So, I mean, to each his own, I give her a lot of respect. But still, nonetheless, just taking a deeper look too, just to give you guys an understanding, Ontario's tax rate's a little bit finicky. And I have these two incomes. I have corporate income. And like I said, it's the two best things you could do is have a corporation and have employment income. And my employment income puts me in a bit of an upper bracket between the $55,000 and $90,000 range. So I'm sitting in this kind of 30 percentile of taxation, which, isn't that fun. So I don't like the idea of paying myself out of my corporation and then, being taxed at 30% when I could be taxed at 15%. So I figure I'd just bite the bullet, save myself the extra 1,500 or 15%. And I'll just use the money I make from my personal job to just actually start funding my TFSA. It's not going to be as quick as I would like it to be, but at the same time, I'm just being super hyper finicky about these taxes because I really hate some of these tax brackets. And it's fun also looking at Canadian dividends. For those of you that are unaware, the eligible dividends, I don't know how this is possible, but they're saying that you pay negative income on those for eligible dividends. Like you're not paying any tax on it for some reason if you're in a lower tax bracket. I really want to ask somebody about why it's showing Canadian eligible dividends for 2024 are actually negative. Like it's like you're not paying any tax on eligible dividends. Whereas if you get into this, 55 to 90K range, you're paying about a 6% tax rate. You know how beautiful that is? Like, not only like I know the greatness of a tax-free savings account to like pay zero tax whatsoever, but you are paying, if this is accurate, if you make income from dividends that are eligible in Canada, you're only paying a 6% tax rate over 55 grand. That like you pay more on withholding tax owning US dividend stocks than you actually do just holding qualified dividends in a regular brokerage account. It's because of the grossing up of the dividends. It's super intriguing nonetheless. Canada gives a lot of benefits from the tax standpoint of investing. And also congratulations too to everyone that's buying SCHD. SCHD is going to pay out the biggest dividend that it's ever paid, 74 cents coming up to, I think in January, they announced, what was it, like 74 cents for December here, which was astounding. And I'm really excited for that because I'm just reinvesting those dividends for now. And, SCHD is still comparably one of the largest positions here. I've got 657 shares that stands today. So I'm really liking this snowball effect now that, not that I'm really seeing any major cap gains on this at all. I'm pretty much flat as it stands today, but I do like reinvesting at these levels because I think with this recent dividend, I think it puts the yield over 4% if I'm not incorrect. So for those that are just looking for income, SCHD is a beautiful place for an RSP where you don't get the 15% withholding. But let's take a look at some of your comments, questions here. And we'll round this conversation up, and I'll give you guys some further ideas. But it's coming in on Monday, SCHD. Oh, so it's actually coming in this month. Okay, that'll be nice. SCHD is a bomb. I love it. I know a lot of people hate and shit on dividends, and I don't understand why there's so much hate. I am a total return guy. Don't get me wrong. Like I am all about total returns, but people are like, oh, the bank stocks are terrible and all this. I'm like, they're terrible if you're buying them at the highs, but at the lows, you're getting crazy rates of return. I mean, for companies that can afford a 7% dividend yield where the payout ratio is, find me companies that pay over 7% that have only a 50% payout ratio like Bank of Nova Scotia. They don't exist. I'm like, you're getting a market rate of return off the dividend, and any capital gains that come thereafter is just gravy. And you're buying it at one of the most suppressed prices we've seen in several years and 20-year high dividend yields. I mean, come on. How do you not recognize the value? Unless you think the whole market's coming to an end, but I doubt that. I love dividends too. I'm a proponent of both styles of investing. I love growth and I love dividends. I see both of them. That's why I try and get my yield, which is abysmal right now, but the goal is to try and build up VDY. So eventually my yield comes to parity at 3%, because that way I feel like I'm getting enough dividends and enough, like I'm not chasing yield. So I'm not giving up all growth either. Because everyone's like, oh, you're taxed on dividends and you're this and you're that and you're blah, blah, blah. It's like, yeah, but if you're efficient about it, you're not really taxed hardly anything at all, if anything. And like dividends, when the market is crappy like it was through 2022, that's all reinvestable income, baby, on top of the money you're already putting into the market. I mean, like, how do you go wrong with these kind of, environments? It's just the best of both worlds. Growth and dividends. Yeah, I know, right? But it depends what you want. Some people, I come from a place of volatility in my life. So like, I've always loved dividends because I've never trusted my job, and I lost my career in 2020, pivoted into this new career. I think this new career is a bit more stable, but it makes a bit more money, but I'd still rather have the reliability of knowing I have income, right? You can pay for groceries with total return. Yeah, I mean, you can totally pay for groceries, but this is the thing, like I told my mother, right? Like, think about when you get to the age of retirement, one of two things is going to happen when you get old enough. Either you're going to be too old to properly manage your portfolio, meaning you're going to have to pay somebody a management fee to do it, or you're just going to hold resilient companies that have been around for 100 plus years. They're going to pay you a yield and you're never going to sell them and try and manage it. Because you got to remember, total return is great until the market goes down in 2022 and you need to pull money out to survive, right? That's when all of a sudden people are like, oh, dividends aren't that bad. Oh, they pulled the dividend. They pull it out of the stock price. It's like, yeah, no shit, but that money is coming from the earnings per share, you idiot. It's like the company makes the money and then they pay the money out. Then they go and make more money and they pay that money out. It's not like you're degrading the total value of the share. You're just taking it from the earnings. And newsflash, the entire value of a stock is purely perception based. Like, just because they pull the value out of the dividend and the share, the stock could still drop dramatically. Even though, Google makes good earnings, that doesn't mean the stock is just going to go straight up. It could go dramatically down, Earnings don't dictate share price, but dividends are reliable. It's guaranteed cash flow no matter the value of the share price if the company can afford to pay the dividend. So in retirement, when you're getting crippled and like mentally malfunctionable, like and I told my mother this, like you don't want to have to watch the stock market. You just want to pull the cash flow out and completely forget you own investments. It's the best thing you'll ever do in your retirement. Get to a place where you're covering your bills and then put some money into some growth stocks. And then like the S&P 500. And when the S&P 500 does exceptionally well one year and you want to go on a trip, then take some capital gains. That's what you do with growth stocks in retirement. You only use them as a bonus, in my opinion, because it's too risky to try and self-manage pulling it out. Once a magician, always a magician. I got to do a magic show for my corporate Christmas party. Not my like the company I work for. They talked me into doing a magic show. I'm a little rusty, but it's coming. You can't fake a dividend. I mean, you can pay it with debt. I mean, to some degree you could fake it, but you can't fake the cash flow that gets paid out. I mean, that's just it, right? It's hard money. That's why people love real estate so much, because you get paid hard money. I don't know what the difference between real estate and dividend stocks are. It's the same hard money. It's earned income. It's like, yeah, grab some more Enbridge today. Congrats. Enbridge is probably, I think, at a good price here. Thoughts on Oracle earnings coming up? Are you talking about big Oracle? I really don't follow it as much if you're talking about the big tech giant. There's a few different Oracle kind of stocks. There's some small caps that are called Oracle. Does Kyle have SHD in his TFSA? No, I showed you. It's in my RSP. You have to pay withholding tax, so I don't really own it in my TFSA. I'd rather just own the S&P or maybe even something like the Qs. Dollar bills, y'all. Let's get it. RioCan paid me 5 figures of hard money today. Congrats, man. That is truly baller. Let's just see what else we got here. Growth and dividends. That's the plan. Hate SCHD good for TFSA. Can be. I mean, if you want the income, like even in my parents' tax advantaged accounts, like she owns some US stocks. She's going to pay the withholding, but for the diversity of the portfolio, it's just smarter. Just depends on what you want. Like if you want cash flow, like think of it this way, you're only paying the withholding. The rest of it's completely tax-free. Whereas if you buy it in your RSP, you're not paying any withholding tax, but when you draw against it, you're going to pay your marginal income bracket. So if you need the money today, it's better to hold SCHD in your TFSA. If you don't need the money today and you just want it to compound, it'll compound faster in your RSP. If your only income was Canadian qualified dividends in Ontario, can you collect up to $68,000 to pay zero tax? I don't know. I was just looking at the 2024 tax rates and I was just kind of shocked to see what those numbers were. So I am just as curious as you are. I got to do my accounting in January for some of the corporate stuff. So I'll ask her actually about it because she'll probably know more than I do. So it should be the taxation in Canada is wild compared to the States, in my opinion. Grossing up the dividends, swing trading for the win. Yeah, if you're good at that. Yeah, that's too much of pain for my taxable account. Yes, you must have capital gains loss in Canadian dollars for all U.S. foreign transactions to CRA and taxable. What else we got here, guys? Thoughts on XEQT? As someone who tired of self-weighting my ETFs, thinking of just putting monthly auto buy on and in my Wealthsimple, and I don't need to even look at my portfolio. So XEQT is what? Let me pull this up here real quick. XEQT. Yeah, I mean, that's what ends up happening, right? Like I work in the markets every single day, so I'm surprised I'm not like more into individual stocks right now, but you're just basically talking about the iShares Core Equity ETF portfolio. What are the holdings in this? I would just make sure you're diversifying because I think the problem with Canadian investors is they focus too much on the Canadian markets. I see that a lot in a lot of the big Canadian YouTubers out there, and I just feel like they're giving up a lot of returns. So yeah, this is pretty diversified, right? Because you're basically just getting emerging markets. Like this is one ETF to own them all. The only thing I don't like about it is the really high expense ratio here at 0.2% is a bit high for me for a broader market ETF because you're 45% US. 23% Canada. What I would probably prefer to do, if anything, is maybe just pick like a US ETF. Like, I don't know. I feel like 0.2 is really high management fee considering VOO is like 0.0 like nothing. It's like non-existent. So you might be better off buying something like, I even think it's hard to buy VFV in Canada because I think VFV has too high of an expense ratio as well, doesn't it? What's VFV here? You gotta be careful with the expense ratio if you're young because 0.2% is I don't mind paying it on something like a VDY that pays monthly because I get it. But yeah, even VFV only charges 0.08, right? Because if you're really young, that eats into a lot of your return over time. So that's why you got to avoid mutual funds. I don't care what Dave Ramsey says. Mutual funds are garbage. VOO versus SPY. The only difference between the two is if you're trying to write covered calls. The SPY is way better for covered calls if you're trying to cash flow better off the S&P 500. But otherwise, I think VOO is great. I like either or. I mean, they're both favorable. Even VFV is great, other than the expense ratio is a little bit higher. But if you're Canadian, you don't want to convert, VFV is fine. Just depends what you're after here. Europe is stagnant. Newsflash, most of the world is stagnant outside of the US. I mean, Canadian markets are okay. I mean, China's market has just been abysmal at best, especially with Charlie Munger continuing to crap on Alibaba. A lot of people like thinking China's cheap, and I've honestly given up on foreign stocks at this point. I've come to realize that I feel, again, everyone's different. I think if you're old, diverse, if you feel comfortable diversifying on a global scale, go for it. But the only stocks that I like globally are companies like BTI, Nestle. Like when I'm looking at global stocks, I'm really looking at companies that I know have good balance sheets and are fairly resilient. Because BTI, I think, is favorable here with its dividend that it can definitely afford, and it's super cheap. And you got like Nestle, that'll give you some European exposure to one of the best European stocks. Nestle, there's Hershey's is great too. These kind of companies I think would be good to buy for diversity, but buying like the broader ETFs in these countries scare the crap out of me because I just don't understand them economically, whereas I'm comfortable investing in Canada and the US. It's just, again, I think it's just personal preference depending on like how you feel about it. But for me, I'm not like one of those strongman personal finance guys where I just need to buy the total stock market index funds. It's just not me. Probably never will be. I like getting a bit of a higher return if I can pull it off by slightly concentrating more. I wish I could find total ETF that trades in CAD that doesn't have crazy. Yeah, I know. I mean, if you're not, here's the thing, like you should be a little bit more comfortable, like even converting the currency. Cause yeah, that initial currency conversion hits pretty hard if it's like up to 1%, but at the end of the day, you do it once. You just do a huge lump sum investment when the dollar is more favorable to the US. And I mean, at least you never have to convert it again for the next 20 or 30 years if you're just buying for long term. So, I mean, that's the way I tend to look at it. And again, I know people hate, you can do the Norbit Gambit thing everyone talks about with Wealthsimple or whatever that ETF, that investment is that lets you transfer USD without paying conversions. But at the end of the day, like, because I've been doing this for 8 years and, I paid conversions my whole life, the rate of return I've had has been nuts. So it's just like, to me, it's just what you have to pay as a Canadian to get that blessing of buying those beautiful US stocks and tax advantaged accounts. Quest Trade, yeah, Norbit Gambit, then yeah, that's probably the best thing you can do, probably. Just look it up. It's a weird, interesting way to transfer currencies without having to deal specifically with the crazy fees, right? I don't think Charlie going to continue to crap on Baba. That's brutal, man. It's funny, but it's brutal. USA still makes up 55% of the total world stock. Yeah, because the market caps are so big, right? Because they're market cap weighted. It's not an equal weight ETF. There was a guy that I laughed at almost because he was saying to buy an equal weight ETF is better than buying even the S&P 500 because he thinks tech stocks are overvalued. I agree. I think tech stocks are largely overvalued, but I still recognize that you don't know what happens tomorrow. And those tech companies make a god awful amount of money. And, a 30 PE, I don't think is the biggest deal in the world that they can start getting back up to a 20% growth rate and they're reinvesting capital and buying shares back. Like their earnings per share growth is going to be absolutely nuts. So, I mean, you're paying for that, right? It's just a matter of if it's going to be consistent. It's funny how scared people are about this market that I would have taken a loan out to invest in. So I didn't have the balls this time around. Actually, if you guys have been OG in 2020, when the pandemic hit, I actually took out a $20,000 line of credit and I invested it in the market because I was so confident, it was so overblown. And I made like not crazy. I wish I bought more tech companies, but I bought Ryokan at like 14 or 15 bucks a share because the dividend was so high. And I was like, well, I can pay the debt with the dividend and it'll cover the debt payments. And then I could get the rate of return, right? So we did that back here. And we rode that wave up. And then somewhere up here, I ended up selling it. And I made a really decent like return and I paid the debt off. It actually worked very favorably, but I don't have the balls to use debt anymore. Like there has to be real specific reasons for me to be that comfortable utilizing debt. So just be careful with that. And I used a line of credit, which was dumb. If you're smart, you just get margin. Margin has way lower interest rates than my line of credit did at the time. But even back then, my line of credit was like 3 or 4%. And Ryokan was spitting out like a stupid high yield of some kind. So, I mean, it was really easy. I was like doubling up on the dividend. Kyle, what should I do? I have money saved up for deposit on real estate or put it all into the stock. So, I mean, if you want to buy real estate within the next year, I wouldn't put it in the market. I actually, like I said, I sold a bunch of my stocks super preemptively because I didn't trust the market and I didn't want to be left up to the risk of the volatility. So, I mean, typically any money you need within, I would say 1 to 3 years, you shouldn't have in the market. Put it into a money market fund, put it into a GIC that's cashable, put it into, you know, high interest savings ETF, like the cash ETF or I think PCA is one as well, because you can still collect 6%, but you have none of the risk. So if you want to find a good deal and you need the money liquid right away, I mean, even my parents did that with the money when they were buying another retirement house. I mean, they put the money they were going to use for a house into a cashable GIC and they made an extra a few grand off it. In a short period of time. It's usually the best thing to do. Looking for GTA condo townhouse. Good luck, my friend. It's still a great, I know a bunch of guys that actually just bought real estate. It's a great time. Everyone's going to tell you it's not a great time. I'm saying it's the best time imaginable. Because remember, you can always negotiate the price of the house. You can't, I mean, you can't negotiate, or sorry, once you buy the house, you can't negotiate the price anymore. And you go back 2 years ago and you'd been paying crazy amounts for a house in Ontario, right? Now you can negotiate the price down. And then later you can negotiate the interest rate when it readjusts. You can always negotiate the interest rate. You can't negotiate the price once you pay. So I think if you've got the money to do it and you can put a higher deposit down, call me crazy, but this is probably the best time to, that's why we did it. I just had a gut feeling. I was like, you know, I wanted to rent, but you know, if you have the money, why not? Do you buy U.S. stocks only in your RSP on or margin, or buying on both seems fine? So can you even buy? Well, I don't even think you can open a margin account in RSP, can you? I know you can borrow money from banks to put it in your RSP, but I don't know if you could do it directly in that account. Yeah, I like U.S. stocks. I don't care. I'll buy them in any account realistically. It doesn't, except for high yielding U.S. stocks, because the dividend gets eaten up too dramatically. So I'm a little more tax efficient. But growth stocks like Berkshire or Google, just buy it in a regular account. You don't have to worry about it as much. But I'm not sure what you mean by margin. I think there is still more pain ahead. Prices could come down. Yeah, absolutely. I think we could see a correction. I don't think we're going to see like a crash. You know, the NASDAQ could correct a bit here. I know tech's getting a little heated, but at the end of the day, stocks are still favorably valued. There's no black swan event happening right now. And, you know, oil's crashing. I mean, everything is looking more and more favorable for the end user and the economy. I mean, Canada's been fighting off a recession. The data keeps coming back that we're not seeing a direct technical recession. And it looks like it's going to be a soft landing, man. And, you know, the only thing expensive is tech companies, but the rest of the market is cheap. Like, what's the PE ratio on SCHD right now? I mean, SCHD that represents the Dow, also representing like the lower half of the S&P, in my opinion. Look at the price to earnings multiple on this. It's kind of like mind boggling. Let me see. I'll just find it real quick here. PE, where's the PE in here? Yeah, where are we? Price to cash flow is only 8 point. Yeah, right here. Price to earnings. Look at this. Look at this. The SCHD. I mean, I'll get this out of the way here. If you take a look, I mean, it's only 14. I mean, you know how crazy that is? That's like starting to get below market average. And these are great. These are all big, like S&P 500 companies, man. Price to cash flow is 8 and price to earnings is 14. That's why I don't understand why everyone shits on SCHD so much. They're like, oh, just cost average the S&P. SCHD is garbage, dividends, tax on dividends. It's not efficient, blah, blah. It's like, if you're all about value, SCHD is the value play right now. So I just have a hard time believing we're going to crash much beyond, you know, we're not going back to the 2022 lows. I just have a hard time believing it. Margin account and Quest Trader, that's what you're discussing there. Yeah, I wouldn't, honestly, margin typically scares the shit out of me. I'm like Dave Ramsey in that aspect. I hate debt. The only debt I have in my life is the mortgage, and it's a really reasonably, you know, it's well within our means, because at the end of the day, like, debt is just, I don't know, it scares the crap out of me. You never know what happens tomorrow, nuclear war. You could also refinance the mortgage with interest rates that'll lower the monthly payment, but you would need to pay more in the interest with a longer time. Yeah, I mean, we got a 3-year fixed. You know, I took a 3-year fixed out at 5.8%. Which right now you can't get anything below 7, I think. So we got a really good rate, in my opinion, a good rate at the current time. But yeah, I'll readjust it in 3 years. I mean, I've already paid down so much of the mortgage since we got it. But I mean, in 3 years, I'm expecting like the rate to drop in half, because, well, the payments will drop in half because we're going to pay as much as possible, because you can put an extra 15% against the mortgage a year. So if we can pay down half the mortgage in the next 3 years, which is my plan. If I keep making the kind of money that I'm making with the wifey, we put those extra payments on it, and then the interest rates come down to 3 or 4%, and we can knock another 1.5% off our payments. When we go to renew, man, like we're going to see a massive drop, which will be great. So we just have to survive. So all you have to do is put enough money to make the mortgage payments for a good couple years, and you're good. I mean, instead of putting that extra in the deposit, you just put extra in an account, so you don't have to worry about it. Use it as an emergency fund. Yeah, VYM is good too. VYM is another really good dividend ETF. Mortgage is good debt. I don't think a mortgage is good debt. A lot of people say mortgage is a good debt. Mortgage is only a good debt if you've run the math correctly, because I think, what do they say? Your total household expenses shouldn't be more than, in my opinion, 50% of your take-home pay. I mean, that's everything household related. I think our mortgage payments are like, they're really small. I think it's no more than like 20 or 30% of our total take home. But, mortgage is only good debt if it's within your favorable income range, because some people get over leveraged. Like in this market, it's easy to buy too much real estate, and someone will be like, oh, it's good debt though. It's really not. No debt is good debt. All debt is bad debt because you're making somebody else rich, which is why I hate it so desperately much. But again, at least you're paying yourself, and you're the only good thing about a mortgage is it's controllable. With rent right now and how much rent's gone up, the thing with the mortgage is you're always bringing the rent down over time and not up. It's a controllable inflationary thing that I think people should get control of in their life. At some point, everybody should own real estate. It's a factor to building wealth for sure. Mortgage is good out of its commercial properties like multifamily or apartments. Yeah, obviously, yeah. If it cash flows and pays the debt, then it's really good debt. I mean, if the debt's paying itself, then you're set. But for a personal residence, I'd rather just pay it off as soon as possible, within means, obviously. In a higher interest rate environment, it makes more sense to pay the debt quicker. In a lower interest rate environment, it's better to slowly pay the debt because you'll probably make a higher rate of return off the market. It's control of your living cost. Yeah, exactly. Hey, Kyle, have you ever watched Strongman Finance? He's pretty hilarious if you want to listen to a former Oh, yeah, no, that I've seen a lot of his videos. He'd probably make fun of me because I talk about like there's no way that guy would be favorable into my investing style. But again, I've done great over the last 8 years, and I'm not saying what I've done is replicatable or it's the way to invest. That's the problem with Strongman as well, is that he's so caught up on one aspect that he thinks is an end all be all to investing for everybody. And I just don't think that is a true definition of investing, because it's just not the same. Like if you're in Europe, investing is going to be different than if you're in Canada. Like there's so many variants, I think, to like the condition of your income, like how much money do you make? Because if you make a lot of income, like why not speculate on the venture capital market like Kevin O'Leary does? I mean, if you work in business and you have some kind of an edge like Warren Buffett or Charlie Munger, I mean, why would you listen to him? Like, especially if you know an industry extremely well and you think you have a higher percentage of winning at investing in certain markets. Like there's no one size fits all shoe for investing, in my opinion. So, that's the only thing that I kind of like tweak against him. But I agree, most of us are clowns. The entire finance industry on YouTube has become clowns, because most people will not show you their returns, which I always do. Like my rate of return has been great over the last 8 years. Whereas I'd love to see like, Meet Kevin's or, especially like Everything Money, anybody that's selling you a course on day trading and all this crap, they just never show their rate of return. So it's a lot of conny weird stuff that goes on out there. That's why I just try and be as transparent as possible, because you can bitch at me all you want, but at least I show the math and the numbers. It's it's like finances are personal. Yeah, that's the thing, right? That's why you try and you don't want to watch one investor. Try and watch a bunch of them and just figure out what works best for you, right? I watched simply for the entertainment. I disagree with his one size fits all. Yeah, but you should watch everybody. Like I love listening to everybody, right or wrong. I watch Me Kevin. I'll watch Everything. I watch Strongman. I love seeing everyone's opinion. But at this point, folks, my sauna is closing in 20 minutes and I want to go warm up. So stay cool, stay awesome. And as always, keep buying, folks, because look at where it's taken us so far. And I'll catch you guys probably next week. Peace.